Zombie apocalypse.
Hello everyone, welcome back to Eco Talks with Sneha Manerikar. In today's session, we'll discuss few more questions from agriculture finance. So let us start our session with first question. Which of the following is not a program executed for rural development? A. SFDA, B. AREIF, C. IRDP, D. MFAL. Answer is the program which is not for rural development is AREIF. SFDA, that is the Small Farmers Development Agency. In 1969, RBI had appointed All India Rural Credit Review Committee under the chairmanship of B. Venkatappan. This committee recommended the establishment of SFDA, that is Small Farmers Development Agency. The scheme was started in 1971-72 in selected districts. It was financed by central as well as state government. And provision of subsidy was made for farmers from 25% for non-tribal farmers and to 50% for tribal farmers. So later in 1980, this program was merged with Integrated Rural Development Program, that is IRDP. Next program was Marginal Farmers and Agriculture Labor Development Agency. It was formed on the recommendation of same committee, that is All India Rural Credit Review Committee, and it was implemented along with the SFDA. This was for marginal farmers and agriculture laborers. SFDA was for the small farmers. The AREIF, that is the NABARD scheme, NABARD refinance scheme, which is Agriculture and Rural Enterprise Incubation Fund, to enable voluntary agencies or non-government organizations supporting rural enterprise to avail bank credit. A special fund, that is AREIF, is set up by the purpose of rupees 5 crores. Means under these schemes for voluntary agencies or NGOs who are supporting the rural enterprise. For them, the NABARD was giving the finance up to 5 crores. So here it is related with the business development and not with the rural development. So this scheme is not for under the category of rural development. Next scheme was the Integrated Rural Development Program. The concept was first proposed in 1976-77. Then it was unified. It was unified field instead of multi-purpose approach. In this program, IRDP, many previously existing schemes were brought together so that there will be no much multiplicity of programs. There will be a single program which compromises of all the objectives. So it is not a technique but a plan of detailed action for development of rural areas. It was introduced in India on expanded scale in 1978-79 in 2,300 blocks, and in 1979-80 another 300 blocks were added. From October to 1980, after launching of 6th 5-year plan, this program was extended to whole country. So in each block, 600 families were to be covered under the program. Out of this, 400 were to be covered through agriculture and related activities, 100 families through rural industry, and there are 100 families under rural service business enterprise, etc. Now the programs which merged with IRDP were, first was the Employment Guarantee Scheme, then Food for Work Program, then SFDA, Small Farmer Development Agency, MFAL, that is Marginal Farmers and Agriculture Laborers, then Drought Prone Area Program, Desert Development Program, and Command Area Development Program. These all development programs were merged to form a single program, that is IRDP. Next question is, the concept of self-help groups came into existence due to the fact that A. Small and marginal need financial assistance for consumption purpose. B. Majority of small and marginal farmers are not credit worthy. C. The cost of credit is low for small and marginal farmers for availing short-term and medium-term loans. All of the above. Answer is, the purpose of for the self-help group to come into existence was small and marginal need financial assistance for consumption purpose. So self-help groups, these are the informal associations of people who choose to come together to find a ways to improve their living conditions. Now, main purpose for existence of self-help group was few peoples of same socio-economic background, they came together, they started saving money, and they started lending money to each other. So collectively they started using the money, so that to meet their small and marginal needs of money for consumption purpose. So that was the main motive for establishment of self-help group, and later this self-help group also started for some together carrying out the business, the small house cottage industries, like that they went on growing. So a self-help group, these are the self-governed, peer-controlled information group of people with similar socio-economic background and having desire to collectively perform a common purpose. They became the source of income also and source of our loan also. So self-help groups that came into existence with this motto. Next is the loan advanced by bank to drip irrigation firm is called as A. Pledge loan, B. Open loan, C. Chattel loan, D. Indirect loan. Answer is the loan given for drip irrigation firm is a indirect loan. Based on the contact, credit is classified as direct loans and indirect loans. Direct loans are one which are directly given to farmers, whereas indirect loans are loans given to the agro-based firms, like input producing firms, like for fertilizer, pesticide industry. So drip irrigation is also one of the input. So loans given to drip irrigation firm is the indirect loan. Next question is, which of the following is not the constituent of World Bank? A. IDA, B. IFC, C. ADB, D. IFC. Answer is, which of the following is not the constituent? ADB. Here now B and D options are same. So answer is ADB. ADB is Asian Development Bank. So let us see in detail about the World Bank. World Bank, it is the full World Bank Group. It is an international organization affiliated with United Nations and designed to finance the project that enhance the economic development of the member states. Now, headquarters of the World Bank is at Washington, D.C. Then what are the components of World Bank? First one is the International Bank for Reconstruction and Development and International Development Association. These together two members are called as World Bank, and other members are other families of World Bank is International Finance Corporation, that is IFC, C. Multilateral Investment Guarantee Agency, that is MIGA, and International Center for Settlement of Investment Disputes, ICSID. These are the extended family member of World Bank, or it is all together is called as World Bank Group. Next question is, which of the following is not regulated by RBI? A. CRR, B. Bank rate, C. IRR, D. Reverse repo rate. Answer is IRR is not regulated by RBI. So repo rate is the interest rate at which RBI lends money to the bank, that is for short term. And reverse repo rate, it is the opposite of repo rate, that is the borrowing rate at which RBI borrows money from banks. Repo rate, when RBI lends money to bank, that is repo rate. When RBI takes money from the bank, it is reverse repo rate. Then cash reserve ratio, it is banks in India required to hold certain portion of their deposits in form of cash. However, banks do not hold this cash with themselves. They deposit such cash with the Reserve Bank of India, which is considered as equivalent to holding cash with themselves. The minimum ratio, that is the part of total deposit to be held as cash, is stipulated by RBI. That is, it is fixed by RBI, and it is known as cash reserve ratio. Then next is the SLR, that is statutory liquidity ratio. Every bank is required to maintain at the close of business every day a minimum proportion of their net demand and time liabilities as liquid asset in form of cash, gold, and unencumbered approved security. So at the end of the day, at the closure of the day, bank has to keep with them a liquid asset, or to meet the now next day's net demand or time liabilities. So that is called as statutory liquid ratio. The ratio of liquid assets to demand and time liabilities is known as statutory liquid ratio. This is also fixed by the RBI. Next is the marginal standing facility. It is a special window for banks to borrow from RBI against the approved government securities in emergency situations like acute cash shortage. Now, if there is a cash shortage, then MSF, this is the special facility provided by RBI, to which the banks can take the immediate loan from the RBI. Next is the bank rate. It is the long-term rate at which central bank, that is RBI, lends money to the other banks or financial institutions. Bank rate is not used by RBI for monetary management at present. So, bank rate, it is the long-term concept of repo rate. Repo rate is the short-term concept. Bank rate is the long-term concept. Now, this is the present prevailing rates. Repo rate is 4%, reverse repo rate is 3.35%, marginal standing facility rate is 4.25%, bank rate 4.25%, CRR 3%, and SLR is 18%. This is the on dates RBI rates. Next question is, what is next is internal rate of return. Question was asked which is not governed by the RBI. Internal rate of return, it is the metric used in financial analysis to estimate the profitability of potential investment. It is the discount rate at which NPV is 0 when it is discounted. So IRR, it is for a particular business or a particular project. It is not governed by the RBI, while all other rates which are given in the question are regulated by the RBI. Next question. LAMs came into existence in year A 1971, B 1975, C 1980, D 1972. Answer is LAMs were established in 1971. Next question. LAMs came into existence to meet the credit needs of A, weaker section, B, large farmers, C, medium farmers, D, tribal farmers. Answer is LAMs were for the credit needs of tribal farmers. Next question. The jurisdiction of LAMs is A, one district, B, one village, C, one taluka, D, none. Answer is one taluka. That is, area of operation for LAMs is one taluka. Actually, it is more than a taluk, less than a district. That is the area of operation for LAMs. Next question is, LAM came into existence based on the recommendation of dash team or dash committee. A, B, Shivraman, B, Bawa, C, NCA, D, M, Narsiman. Answer is, LAMs were recommended by Bawa committee or Bawa team. So here is the summary of the LAMs. LAMs is large size Adivasi multipurpose cooperative societies. In line with the objectives of FSS, that is Farmer Service Society, one more society was established, that is LAMs, in December 1971 on recommendation of Bawa team appointed by the Government of India in tribal areas of the country. This main motive was for the tribal, as the name suggests, it is for Adivasi, that is tribal people. Objective was to provide all types of credit, including consumption credit, and intensification and modernization of agriculture with appropriate technical guidance, and improving marketing of agriculture and forest products in tribal areas. Overall, it was for the tribal peoples. And management of LAMs included 11 board of directors. These 11 members were 5 tribal members, 2 non-tribal members, 2 nominated by Register of Cooperatives, and 2 nominees of lead bank. This constituted the management, that is board of directors of LAMs. Next question is, which of the following is not the component of cost of credit? A, loan amount, B, interest rate, C, loss of opportunity wage earning, D, all of the above. So what is not the component of cost of credit? Answer is loan amount. Loan amount is not the cost of credit. It is the credit act. So cost of credit is nothing but whatever cost is incurred to get the loan. That is the cost of credit. There are various costs associated with loan. These costs are in addition to the interest rate component and range from bank fees and charges to the third parties cost, such as legal fees, insurance and government levies. etc. So because loan applicants will tend to focus only on the interest rate while making the decision of on from which bank to take the loan. So banks have proactively adopted the annual percentage rate or APR model that converts all the direct cost associated with loan into one number, that is the APR model. That's all about today's session. If you have any doubts, you can ask me in the comment section, and don't forget to like, share and subscribe. Thank you.